Okay, next on Chapter 9, Section 2, we're going to talk a little bit about recording purchases and how we organize that in our special journals. A list of assets, usually containing the value of individual items, is called an inventory. There are different kinds of inventories. For example, a company might have an inventory of office or store supplies, equipment, or goods for sales. The goods a business has on hand for sales to customers is called your merchandise inventory. Everything they buy and they're going to resell to their customers is called your merchandise inventory. Merchandise inventory is an asset account. Its value is recorded in the general ledger account titled merchandise inventory. And again, it's an asset account because it has value and it is something you own. Two principal methods are used to determine the value of your inventory. The perpetual inventory method is determined by keeping a continuous record of increases, decreases, and the balances on hand of each item of merchandise. When a perpetual inventory system is used, purchases of merchandise are accounted for directly to the merchandise inventory account. Businesses that use the perpetual inventory method usually have computerized accounting systems to efficiently maintain the detailed records that are required. Those records would include a record for the units purchased and sold, as well as a current quantity on hand. When the barcode of merchandise is scanned, the system instantly records the sale price and updates the merchandise inventory. The perpetual inventory method provides a business with a better information for controlling the cost of merchandise it sells. So again, as you use the barcode, it keeps track of everything in a perpetual inventory method. In a periodic inventory method, this is a merchandise inventory is evaluated at the end of the fiscal period. When a periodic inventory is conducted by counting, weighing, or measuring items of merchandise on hand, and this is your physical inventory. A merchandising business may conduct a periodic inventory once at the end of each fiscal year, quarter, or every month. It depends upon its volume of sales. The periodic inventory method is easier to maintain than a perpetual inventory. That's because a periodic method does not require records of quantity and cost of individual goods. Merchandising businesses with manual accounting systems usually use the periodic method. And again, that's just counting your inventory and doing adjustments, kind of like what we did before. Your cost of goods sold. 3 Green has chosen the periodic inventory system. And again, that's checking your inventory at the end of the fiscal period and making adjustments there. The amount a business pays for the goods it purchases to sell is called your cost of merchandise. The cost of merchandise is recorded in the purchases account. Merchandise or other items bought are recorded and reported at the purchase price. And this is called your historical cost. It is an accounting concept. Okay, so merchandise, anytime you bought it, they are bought and recorded at the purchase price. Only items purchased for resale are recorded in the purchases account if you're going to resell them. Okay, for example, like your supplies that you're going to use up within the business, you are not going to do that. Here is your section of your chart of accounts. It's the 5,000 section, or if you use the smaller numbers, the 5 section, which earlier we used as our expenses, but now it's going to be the section for our cost of goods sold. The cost of goods sold section includes all the costs necessary to make an item of merchandise available for sale. That includes the purchase price and any related costs or discount. For example, freight charges paid to ship items to the merchandising business are cost of making the item available for sale. So they would be recorded in the purchases. In contrast, the freight charges paid to ship an item to a customer would be accounted for as an expense, and it would be recorded in like a freight expense. So for example, you purchase something, you have to pay shipping. That is also included in your purchase price. And you can see in your cost of goods sold section, you can see that you have your purchases, your purchase discount, your purchase return allowance, and we'll get to the discount and your purchase return allowance. Accounting concept again that we've used before is the cost of merchandise sold should appear in the income statement only when the goods are sold. So again, we're going to be working with our matching expenses with revenue section, or concept, sorry about that. Going on to ordering merchandise. The process of ordering merchandise begins when an authorized employee submits a purchase request. A form requesting the purchase of merchandise is called a requisition. The requisition includes sorry about that. Let's start again. The requisition includes the description of the merchandise to be ordered, the quantity to be purchased, and the required delivery date. Requisitions generally require manager approval. After the requisition is approved, it's submitted to another employee who is responsible for placing the order with whichever supplier provides the best combination of quality and price. A form requesting that a vendor sells merchandise to a business is called a purchase order. And this would be an example of it. The purchase order lists the number, the description, the quantity, and the unit price. And you can see right there, the quantity, the description, whatever stock number it is, and whatever the unit price is. The vendor uses the purchase order to approve a sale and to process the order. No transaction occurs until the customer receives the goods from the vendor. Thus, no journal entry is recorded when a purchase order is prepared. For many businesses, the internet commercial sites provide an alternative method for ordering merchandise. Rather than sending a purchase order to a vendor, the customer simply orders the merchandise online. This offers several advantages. First, delivery of the merchandise is faster. And second, the vendor does not have to enter the purchase order information into its computerized accounting system. For this reason, some vendors offer customers a discount off of the purchase price for placing their orders online. Special journals. The accounting procedures taught in the first part of our unit provide an effective system for a small business with limited numbers of transactions, what we did with the web service. However, a business having many daily transactions could not efficiently operate using single journal. To increase efficiency, separate journals were developed to record transactions impacting similar accounts. A journal used to record only one kind of transaction is called a special journal. Businesses typically use 5 different types of journals. The first one, and we're going to use all 5, but we're not going to learn them all at once. The purchase journal is for all purchases of merchandise on account. Anytime you purchase merchandise on account, we're going to use a purchase journal. The second journal that we're going to take a look at is our cash payments journal, and it's for all cash payments, just what it says it is. Then we have a sales journal, and again, it's for all sales of merchandise on account. We have a cash receipts journal, is anytime we receive cash, and then we will have a general journal for all other transactions that don't fit in the previous four. In this chapter, we're going to look at the purchases and the cash payments, and then we'll hit the other ones later on. A transaction in which the items purchased are to be paid for at a later date is called a purchase on account. A business can purchase merchandise or buy services and supplies on account. A purchase journal is a special journal used to record only purchases of merchandise on account. Each purchase of merchandise on account is recorded on one line of your purchase journal. It would look like this. This is what your purchase journal looks like, and you'll like this one because you'll notice there is one amount column. The amount column, though, has two account titles. If you look right here, it has two account titles. It has a purchase debit and an accounts payable, because every time you purchase on account, those two specific accounts are affected. Okay, so our rules that we had before, where every journal entry affects at least two accounts, they are affecting two accounts. It's just that it's in one column. A journal amount column headed with an account title, remember, that is called a special amount column. And again, special amount columns are used for frequently occurring transactions. Using special amount columns eliminate writing general ledger account titles in the account credited column, and it makes it a lot easier with less mistakes. Excuse me. Remember our accounting concept, objective evidence. A source document is prepared for each transaction. When a vendor sells merchandise to a buyer, the vendor prepares an invoice showing what's been sold. And again, this is going to be a purchase invoice that we're going to take a look at. So again, an invoice used as a source document for recording purchases on account is called your purchase invoice. An agreement between buyer and seller is called your terms of sales. It will be on your purchase invoice, and it also shows the due date whenever you need to return or make payment. So this is an example of your purchase invoice. If you take a look at it here, the first thing when you get a purchase invoice, you're going to record the initials of the employee processing the invoice, the date received, and the purchase invoice stamp. So up in here, somewhere, they are going to record when you receive this invoice, who received it, ACL received it, those are the initials, the date they received it, and they're going to record the number 525 on there, and they're just going to keep track of them in order. And this is when your business receives. If you see here, it says it was shipped to us, and then the information is below that, and it's from Win Lighting. Up here, you can see up here who we purchased the information or the merchandise from. Number 2, you're going to place a check mark by each of the amounts to show that these items have been received. You can see there are check marks. They go through the information or the purchases, sorry about that, and they check it off. It's just like when you receive a package, you make sure everything is in there. They check it off there. And then they're going to review the vendor's terms and the payment due. So you can see right here, payment is due on December 4th. Okay, you can also see the terms of the sale. Do you see the terms? N30. That means that the net amount is due within 30 days. That's what the N30 means. So they have 30 days to make payment. Purchasing on account. Okay, so we're going to have a transaction that looks like this. We purchased merchandise on account from Win Lighting, $1,082.50, purchase invoice $525. And again, it's the same invoice here, and you'll notice the document number up here is 525. They will they will write the numbers on there, because if you look at over here, your invoice numbers are going to be all different from all of your vendors. Okay, and so when you receive a purchase invoice, somebody will mark them in numerical order, so they're easy to find when you post. Okay, so our two accounts affected. Remember, purchase is a cost of merchandise account. It has a normal debit balance. Okay, so the total amount of our purchases is going to go up. We purchase some more merchandise. Our accounts payable is a liability with a normal credit balance, and that amount is also going to go up because we owe Win Lighting the amount. So those are our two accounts affected when we purchase merchandise on account. Okay, the biggest thing is people want to put the word merchandise for the account title, but the account title is purchases. So we go to our purchase journal. Our instructions, number 1, we are going to write the date. We're going to write the vendor account title, whoever our vendor is, where we owe the money. 3, we will write the purchase invoice number. 4, we're going to write the amount of the invoice in the special amount column. And again, remember, that's affecting two accounts. We have a purchase debit, we're actually purchase debit, you can see right there, and accounts payable credit. Which vendor are we doing it to? Is Win Lighting. All right, we'll go to the problem next.